So welcome back, everybody, for another webinar organized by Princeton for everyone worldwide. We're very happy to have Lasse Pedersen with us today. Hi, Lasse. Lasse will talk about GameStop, short squeezes and predatory trading and market manipulations. So very glad to have him with us. He will talk. Lasse is an old friend of mine. He's now at Copenhagen Business School and also partner at AQR, but he will speak in his role as academic. So let me first start with some short history about short squeezes. So short squeezes, what are short squeezes? They are special forms of predatory trading where you try to trade in order to manipulate the price, and Lasse will talk more detailed about this. And pump and dump schemes you can also see as some predatory trading. But short squeezes involve short trading, and of course there's this old saying by Daniel Drew, who sells what isn't his must buy it back or go to prison. So that's a famous saying, and we have very famous historical examples of short squeezes. In 1901 we had the Northern Pacific Railroad short squeeze. Then we had 1923, there was a Piggly Wiggly short squeeze on their stock. So this was a supermarket, one of the first supermarket chains in the United States. Then we had the famous Hunt Brothers silver short squeeze in the 1980s. And in Germany, we had a big short squeeze by Volkswagen in 2008, when there was an attempted takeover by Porsche of Volkswagen. And that's essentially, it was probably one of the biggest short squeezes. And now we have seen GameStop and other events, and we want to understand whether that's similar in nature or what's different. And is it actually sensible to increase transparency, because now you can coordinate. If there's a huge short position, you can coordinate and create more easily a short squeeze. And is there some limits on naked short squeeze? So these are all questions we want to address today, and would like to understand also in the light of the hearings yesterday, get a better, deeper understanding what went on and how to understand it, and what are potential frictions and how we can solve these frictions. So what's new? The short squeeze is not a new phenomenon. We have seen it. It started, 1901 is one example. So it's over the whole 20th century and the 21st century. You have it in GameStop. You can just see is another one. What's really new is the social media. So that's the meme investing, where the social media and social media platforms allow one to coordinate better, allow many small investors to coordinate better. And here's the definition of a meme: an idea that is passed from one member of society to another one, not in the chains, but often by people copying it. So that's essentially a meme, and we have seen many of these memes. Another phenomenon of social media, which then spills over to financial markets, are echo chamber phenomena. And you typically learn from other retail investors, but you don't realize often, because of this echo chamber, that actually the message you send out is just coming back and travels back to you, and you treat it as a confirmation of your initial information. And hence you put too much weight on certain information because you don't fully internalize that it actually was just traveling back to you via an echo chamber. So these are interesting phenomena we would like to understand in more detail. But overall, if you have more transparency, which is typically a good thing, transparency also allows for more collusion, or eases the collusion among many traders, because coordination is made easier. And is this a bad thing or a good thing? We would like to understand today, and Lasse will talk about these aspects. In general, there is two views you can have about this investing and what's going on, what happened end of January. So you can think of a phenomenon of many Davids, so many small investors and Goliath, and you have one few big investors. So one view is that we really want to design regulation in such a way that you would eliminate all the inefficiencies, all the manipulations and all this. And we have to really fix the market microstructure, the plumbing, and the regulation has to be done in such a way to eliminate all of these inefficiencies. Even if they come from small traders or from large traders, doesn't matter where they're coming from. You just want to have a very efficient market. There's a second view. The principle for the second view is that you just want to create a fair, level playing field And the argument is that the Wall Street insiders have an unfair advantage in terms of order execution and other things. And hence, in order to create a fair level playing field, it should also be allowed for the retail investors to collude and manipulate as well too. It's a little bit provocative. That's why I put it in this quotation marks, but just to have a fair level playing field. And it's a little bit in economic theory, and using economic language, like the theory of the second best. You have some inefficiencies, and the way to fight inefficiencies is with other inefficiencies. So that's how the theory of second best is working. And so one distortion is fought with another distortion. So you might not want to regulate one side and give all the advantage to the other side. And the second view is very much the idea of this Robin Hood, where you say the crowd is versus the elites. There's democratization of investing through Robin Hood. And typically, Robin Hood traditionally is like you take something away from the rich and give it to the poor. Here, it's more like you allow the poor to compete with the rich because they also have easy market access through the trading app and other elements. And that's, their philosophy. And it's more with the second principle, what I've outlined above. There's, of course, some criticism because Robinhood, the way the business model works is that Robinhood sees the orders coming in, the retail orders, and passes the information on to certain other players. So it's this payment for order flow model. So is this fair to the retail investors? And Lasse will talk about this as well. And you might say, oh, that's actually very unfair because it allows then that retail investors will be front run by some professional investors who buy the information about the order flow. But you might also say it might also reveal non-informed trading from the retail investors to the market makers, and hence the retail investors get a better deal. And so these are the two trade-offs we have to think about that. And then you might also say Robinhood might introduce some gamification in trading. So it's not really about investing. It's more about entertainment and games. And that exploits certain behavioral biases. And that might be tricky as well. And whether we have to look into that in order to make sure that people don't are taking advantage from themselves. Now, let me just say a few words about short interest. There was the argument also yesterday that the short interest, how many stocks were shorted, was exceeding 100% relative to the float or relative to the outstanding. And of course, that's not the same thing as naked shorts. And let me explain what a naked short is, just to be on the same level playing field. So if you want to go short a stock, let's say you're a retail investor, you have to borrow the share that you want to go short, and you have to borrow it, from somebody who owns it, and it's parked with a prime broker or custodian. Against the fee, you can borrow the stock, and then you sell it. Let's say the current price is $100, so you get $100 in your prime brokerage cash, $100, and then you have to keep this $100 in your account. Plus, you have to add a margin, let's say another $10 in your prime brokerage account, because the prime broker might be concerned you sold the stock, but it goes up to 110, then you made some $10 losses. And to make sure that you can bear these losses, you have to park this $10 with the prime broker as well. That's the margin you have to pay. So of course, when you sell short a stock, you pass on this share you borrowed to somebody else who then has the share and he can lend it out again. So you can lend it out once, twice, and so forth. And Lasse will talk about that. But what's the risk now? If you're short, and let's say you sold a share for $100 short, the stock goes up to 110, 120, you get some margin calls. That's one risk. The other risk is that the owner of the stock might suddenly recall a share, that I would like to have my share back, and then you have to suddenly deliver it back. So these are two risks you might be facing. If you are a prime broker, so if you're not a retail investor, you might not have the same risks. But there were also margin calls Robinhood was facing with respect to the clearinghouse. We would like to understand this better. What's about naked shorts? Typically, you can't do any naked shorts, but there's a delay in settlement, 1 or 2 days. So if you go short and then you have to deliver the underlying stock or the share, but it only takes 1 or 2 days until you can do it. So there's a delay, and if you undo your trade fast enough, you might not be able. You don't have to do it. So if you're in a particular special position, you can actually have some naked shorts as well. And there's a question where there's some asymmetry because of that. So these are all detailed questions, but they all matter in order to understand short squeezes and predatory trading, and more generally how the market functions. So details really matter, and we will learn a lot today about it, and also can put this then in the bigger picture subsequently. Let me go to the poll questions, just to summarize briefly the poll questions. So the questions were, who are the predators in the GameStop phenomenon we have seen end of January? Are this the short sellers? 31% said this. The crowd of small investors, 25% this. The clearinghouse, 9%. And the Wall Street bet on Reddit, so this platform where you communicate, 31% said this as well. So that's, we will have to clarify that, who are really the predators in this world, and who are the prey. So that's another who is suffering from that. Should we regulate it, predatory trading and memes investing? So the answer is no, it just balances the power with respect to the hedge funds. That's 13%. That's a small number. No, in general, 46%, and 41% said yes, we should regulate since markets are less efficient. Perhaps people will get a different perspective after the talk, or perhaps they will be confirmed what I've seen. So will predatory traders win at the end, or will they lose out? And actually they will win, the predatory traders, so not the prey, the predatory traders. Only 30% said they will win, and 70% think they will lose out, referring, I guess, to more generally or to the GameStop phenomenon particularly. And our speculative excesses around GameStop, is this just the tip of an iceberg? Or is this, occasionally this happens every few years, special phenomena when markets are not very rational, this can happen, or where some plumbing mistakes are occurring? So the answer for that were 41% think it's just the tip of the iceberg, and 59% think it occurs occasionally only. So it's not, we can fix it, it just occurs occasionally. So with these quick summaries, I pass the virtual floor on to Lasse, he's an expert in many things, and he can tell us all what happened in the end of January and how to put the whole thing in perspective. And we're looking forward to it. Thanks again, Lasse, for being with us, and the floor is yours.
Thanks a lot, Markus, and congratulations on this amazing webinar series you have here. So let me share my screen first of all. I hope you see it.
Perfect.
Great. So I'll talk about GameStop and predatory trading. And what I'll talk about first is very briefly what predatory trading means and as it relates to the GameStop. Then I'll talk about what happened with GameStop and try to provide some data and some evidence on what really happened, what was driving the prices and so forth, why Robinhood restricted trading, and what were the short sellers doing here. And then we'll try to broaden out in the end and talk about what can we learn from this episode more broadly. So let's start very briefly about just understanding the predatory trading. So I guess Markus invited me here in part because we wrote this paper together a number of years ago. And in the abstract, we define predatory trading as trading that induces and or exploits the need of other investors to reduce their positions. And we say that this leads to price overshooting, and we say it leads to a crisis that can spill over across traders and across markets. So you can already hear that it does seem somewhat relevant for the particular GameStop case. But let me just first explain what's not going on, because I think there's a lot of confusion about the effect of demand on prices. So the whole premise of predatory trading in price manipulation is that demand does in fact move prices of stocks, but just like it moves the price of many other things. And there's a lot of empirical evidence now that obviously price does move prices of stocks, just like it moves the price of almost anything else out there. But that in itself is not typically a source of profit. And I think that's one of the misunderstandings. So suppose GameStop was trading around 20 in the beginning, and suppose that a bunch of traders just buy and push the price all the way to 420, just to have some round numbers. So that would be a $400 price increase. So then you could ask yourself, what would be the average price you're buying at? Well, suppose you're buying at just above 20, and then you'll keep buying as the price increase. The average, the midpoint here is 220. It's just between 20 and 420. And probably you, in real life, you would be buying for somewhere above 220. And because you're always buying on the uptick, you're pushing up the price, you'd be buying. So you could say, well, I bought for, let's say, 250, and now the price is 420. So on paper, I have made some money. But what happens is that if you immediately sell, you'll push the price back down to 20, and you'll sell somewhere below 220. So let's say you'll sell at 200, so you'll actually lose money. And in fact, what could easily happen is that the price collapses even before you start selling, and you could end up selling at less than 20. So this is this losing strategy, and this is related to what's called a market impact. So in other words, the fact that you can move the price is a source of trading costs. This is typically not how investors make money. Investors try to avoid moving the price. So this idea that professional investors are moving the price all the time, they try not to. That this is a bad thing. This is not how they want to make money. So what is predatory trading? So predatory trading is that you try to force somebody else to trade, or exploit that somebody is forced, in this case, to buy, or tricked into buying. So it's called a short squeeze or a gamma squeeze. In this case, we'll talk about that. So the idea is price is 20, you're pushing it up, let's say, to 150 or whatever, 200, we could say. And then at that point, you have forced the short sellers, because they cannot sustain the risk, or for whatever reason, when the short seller cannot hold on to his position anymore, when they close their position, they have to repurchase the shares, in other words, buy. So the idea is that it's the short sellers who will then push the price up, and now you will exit the trade. You bought somewhere between 20 and 200, you then exit the trade, you sell somewhere between 200 and 420, let's say, and then the price can collapse afterwards. Okay, so you can do that either by forcing short sellers in a short squeeze, or by what's called pump and dump. You push the price up, and then you trick other people to think that the price is going to continue going up, and then you sell to the people you tricked. Okay, so this is an evil and sometimes illegal behavior, and this is what's predatory trading. So again, it's not just exploiting that you move the price, that also somebody else is going to move the price for you. What is the spillover effect? The spillover effect, so here's a drawing from the paper. Suppose you have these 6 short sellers here on the right, and suppose this line means that whether you can sort of survive and ride out the event. Now, if one of the short sellers runs out of capital, he moves down here, then in this example, the line moves up, then these 3 guys are also forced to liquidate. The idea is the price is pushed up, one guy goes out of business. The fact that he liquidates then pushes the price up more, and that brings the other 3 guys into liquidation as well, which pushes the price up further. So you have this systemic risk or fragility where you can have multiple equilibria and so forth. Okay, so that's basically predatory trading in principle, but now let's talk about predatory trading in practice. Let's talk about what actually happened with GameStop. So first, I'll just talk about some very simple facts. What was the price and so on. Then we'll dig a little deeper and try to understand why did the price move the way it did. Okay, but just sort of at a very high level, the story that you've been reading in the newspapers, I'm sure, is that basically retail buyers pushed up the price. That led to a short squeeze where some short sellers were forced out of their short positions. And so in terms of this picture, the idea is that there are some people, some retail buyers here on the left. They were talking to one another on social media, on Reddit, on a site called Wall Street Bets. Some of them were placing their orders through a brokerage called Robinhood, but they're obviously also using other brokers. Robinhood then allowed them to buy shares of GameStop in the stock market. And they also bought call options. So this is another way of betting that the price will go up. It's a way that has embedded leverage. And so embedded leverage is a way of basically if you have $1,000, you could buy, a certain number of shares, or you can buy perhaps 30, 40 times more exposure to that stock by buying an option. Okay, and so sometimes when that option trade happens and leads to a short squeeze, then it's called a gamma squeeze, because the way it works is that the market maker of the option, the person who sells this implicit exposure to the stock, he will hedge his exposure in the stock market. So he will be buying the share. And in fact, he is pre-programmed to buy more shares as the stock price goes up. And then on the other side, there were some hedge funds who were shorting GameStop. And the most largest and most well-discussed one is called Melvin. And actually, as you know, yesterday there was a hearing in the US House Committee on Financial Services where 5 of the key players gave interesting testimonies. The retail buyer Keith Gill, also known as Roaring Kitty or Deep Something Value, and also the CEOs of Reddit, Robinhood, Citadel, and Melvin all gave testimonies. So that helps us to know even better what happened. Okay. So let's just look at the facts again. What happened to the price? So here I'm plotting the open, high, low, close. So the wildest day here is Thursday, January 8th. So the way to read this graph is that the low here is 112. See how that, and the high is 483, and it opens here and closes here. So this is an astronomical price range in a single day. So in a single day, the price moves from 112 to 483. Remember, a typical, individual stock volatility is perhaps 2.5%, 2-3% per day. So to have these kinds of moves are very, very unusual, to say the least. The price used to be trading in the single digits and with much less volatility, as you can see. The price then was creeping up. This graph starts in early January 2001, and then the price was creeping up from around 20 to around 100, and then close to 500, and then went down from there, and now it's back around 40. What happened to the volatility? You can see it here is that the price over 12 months on a log scale, you can simply see how large the volatility is here in January. It's just astronomical. If you compute an annualized 10-day volatility, it's above 300%. That's just an amazingly high number. Implied volatility went even higher. So volatility was amazing. Turnover, trading volume was enormous. It was one of the most traded stocks in the world. We had at the peak around more than 200% turnover. That means that in a single day, all the shares of GameStop traded more than twice. Let me say that again. All the shares traded twice in a single day. This is incredibly unusual. A relatively small stock becomes one of the most traded stocks in the world. We see that just here on the 28th, as things were going very wild, actually volume went down some, but it had been already going down the day before. But one of the things that's been highly discussed is that some of the brokers, including Robinhood, imposed trading restrictions on this day. Now, before we get to those restrictions, let's talk about why people bought and why people sold. So, let's start with why people were buying. The common story is that you have these retail investors discussing this stock on Reddit, in this subreddit called Wall Street Bets. You have this retail sentiment where maybe some people say because of gamification of trading, there's this app that makes it fun to trade. Maybe it's not a complete coincidence that these gamified traders, they want to buy a stock, GameStop, which is itself selling games. So it's a retail place where you can buy games. Now, most games these days are traded or bought online. So this is why the short seller said, oh, these guys are not going to have a good business because people don't go into the local stores anymore. People buy their games in different ways, but these traders, some of them maybe have just a strong belief that no, these guys can pivot and make a new profitable business. They can go online too, or like some bookstores are still successful. Maybe GameStop can still be successful. Some people have nostalgia, but there was also this very strong sense that shorting was wrong. That they realized there are some people who were short. They wanted to fight against that, and some of them even had the sentiment that they were willing to lose money to have a chance to make these short sellers lose even more. And this guy, Mr. Gill, known as also Roaring Kitty here, was the one who became the famous example of this. Then there were some tweets that also drew attention. There was a famous tweet by Markus Brunnermeier that said this is all due to predatory trading, and it was picked up by Krugman and others. And there was a tweet by Elon Musk that almost got the same kind of an attention, where he said simply GameStop with a link to this website. So that drew attention. We could see it in the Google search data here that these things had a big renewed interest. But was that really the whole story? So I think one interesting piece of the puzzle is trying to look at how much were retail investors really buying on these key days. And Matt Levine, who's a journalist who's been doing some very interesting writing on this, he actually had this table where he cites Citadel for what is their retail buys, the retail sells, and the net, which is the buys minus the sells. And what he reports, I don't know how he got this data on how representative it is, but these are very large fractions of the market, where he says basically on net, retail were buying on Monday. This is the key Monday right here. But they were selling actually Tuesday, Wednesday, and Thursday. So, on the Monday, the price was already elevated. I think it was around, it was trading around, you can see 100. I think it closed around 70 or something like that. So, the price had already been pushed up from 20 to, let's call it 70. So
when was the buying suspended for the retail investors by Robinhood?
That was on Thursday.
Thursday, okay.
Okay, so on Thursday, that's the last day. But even already on Tuesday and Wednesday, where supposedly, these retail guys were pushing the prices into the stratosphere, they were in fact sellers, which is a pretty shocking find. I don't know why this hasn't gotten more attention, or I don't know where the data comes from, but if you take this on face value, there's something else going on. So what is that something else? Let's talk about what it could be. One thing it could be is that it's really option hedges. So it could be that these retail investors were actually doing mostly buying of call options. And so when they're buying call option, it would not be in this table here. And what would happen is they buy the call option, and then the market maker needs to hedge that by going out and buying the stock. And again, this is a way where the retail investors get a very large embedded leverage or return magnification. And also there's this effect that the more the price goes up, the higher is the delta on the option. So the more the market maker needs to buy. So it is, this mechanism does have this effect that it feeds on itself. So that is surely part of it. Another thing that is also surely part of it is that short sellers were eventually forced to close their positions. And so they were actually pushing the price against themselves, just like in our paper. And I'll come back and present some data on that as well. So that was also part of the story.
Explain briefly delta and gamma, just to bring everybody on the same level.
Yeah, so delta is basically how much the option price change as a function of the stock price. So that is how much you need to hedge. And gamma is basically how much that is changing over time. Or not over time, but as a function of the stock price. Now, another potential story where we don't have a lot of data at this point is that institutional investors could be buying here. It could be that, institutional investors, they know that market manipulation is illegal. They know that ganging up to squeeze some shorts is illegal. If they call each other on a taped phone line or email each other or even do it in a bar, the SEC will likely come after large institutional investors doing this kind of thing. And so they don't dare to do this, I believe, in general. But in this case, they could just read in the Wall Street Journal that some retail investors were trying to do this short squeeze, and maybe they would jump on the bandwagon. And so there could be, or I think Markus has a paper where he talks about coordination devices. So it could be that the retail investors became the coordination device, but then a bunch of institutional investors actually started buying into this. I personally don't think that an institutional investor would take a huge position based on thinking that the stock is overpriced, but it's going to get even more overpriced. But there could be a bunch of institutions who took some positions.
So Mark Lackritz would like to know whether predatory trading is always illegal market manipulation, or is it for everybody illegal, or do you know the legal aspects of that?
So I'm not a lawyer. I'm married to one, but I think sometimes predatory trading may be legal. Sometimes it's illegal. I think in our paper we define it as an economic concept, but I think when it's going on in the U.S. public equity markets, it's something SEC is very keen to regulate and look after. So I would think that the things that goes on in the U.S. public equity markets are more likely to be prosecuted by the SEC than many other things. But I think if an institutional investor says, I was reading the Wall Street Journal and I didn't coordinate with anybody else, I just felt like buying, they can probably get away with that. And so that could be another potential story, or it could be other retail investors that are not in this data here. So, there are many potential buyers, but I think option hedgers and short sellers closing their positions, we can be pretty sure is part of the story. So why did Robinhood restrict trading? There's been a lot of discussion of this, from a regulatory perspective. So you were just asking about the SEC and other regulators. Obviously, they will say market manipulation is illegal, but there are different ways to define it. There's issues of securities fraud and so forth. I don't know the legal details. I don't know when trading to squeeze a short becomes illegal, but you are supposed to be buying because you like the stock on its fundamentals and so forth. Just trading to make somebody else squeeze does sound to me like it's market manipulation. Now, there has been some discussion that Robinhood's halting of the trading was illegal because it sort of helped the short sellers in the battle against the retail guys. Now, we know now from the sworn testimony of the Robinhood CEO that is not what happened. We know that the reason they halted their trading because Robinhood itself had margin requirement that they had difficulty meeting. And there's been some discussion that those large margin requirements imposed by the DTCC and the NSCC, the clearinghouses, they were related to the fact that settlement takes 2 days, and that means that the clearinghouse itself has significant risk, and therefore they need large margin. So we actually now from the hearing have this data. So I'm zooming in here. So the retail guys facing Robinhood, there's a margin requirement in that connection potentially, and Robinhood is facing the clearinghouse and has to pay a margin requirement or pay post margin capital. And actually Robinhood showed this data where in the beginning, they had a margin requirement of around $100 million, and that grew on the 28th to 1.4 billion. The reason it was so large is that, when Robinhood buys GameStop, then it takes 2 days before they actually pay the money and get the stock. And, a lot can happen to the stock price in the meantime, and the clearinghouse has to make sure that they make good on that transaction, that they actually pay for the shares, and also are delivered the shares.
So Lasse, can you explain how the level of the margins are set? I mean, you calculate the value at risk, but you look back at an average volatility or just within the last few days volatility? Do you have an idea how the clearinghouse is setting the margins?
It is based on a value at risk, so it's based on a calculation on the volatility in how large the positions are, how concentrated they are, and so there will be, when positions are very large and very concentrated in a few names, there's very little diversification. And when the volatility of those names, so in the case of GameStop, went north of 300%, that led to this incredible rise in also, Robinhood getting new investors and making new buys and sells. And then they also, in their testimony, said that there was this excess capital premium charge of 2.2 billion. So this is a very large number that came on top of the value at risk calculation. It's not completely clear why they got that, but it could be that basically if you get a margin call, that is, you have too little money in your account and they keep having to ask you for that money in your account. So you're supposed to presumably always have extra cash in your account. You shouldn't sort of run out and send money after you're in the red. And if you keep doing that, you can get this extra penalty. That might be one reason. But somehow they got out of paying the 2.2 billion. They didn't have the 2.2. They did have the 1.4 billion, but they didn't have the 2.2 billion extra. So then they imposed this restriction that people couldn't buy because, again, that wouldn't really work for them because they didn't have enough money to pay the clearinghouse. And then they raised 3.4 billion from their own investors, but it took them a few days to get the 3.4 billion. It's not exactly pocket change even for the investors. So that's basically why they restricted buying.
So Hendrik Besenbender makes a good point. Doesn't Robinhood collect margins from its own traders or own clients and then raises funds this way and passes it on to the clearinghouse? Or was Robinhood not increasing the margin requirements on their own?
Yes, so that's a good point. So Robinhood is itself, most of the customers of Robinhood are making their transactions in a cash account. Some of them are doing it in a margin account. And so the first thing they could do is to increase the margin requirement on those who buy on margin. Because if a Robinhood retail investor is buying on margin, he's borrowing money from Robinhood. And this is a problem for Robinhood. Robinhood itself is running out of money. So actually what Robinhood did was they increased margins to 100%, even before they restricted trading. So this was the first course of action to say, basically lend this money to the retail guys. Now they had other ways of, so they I think when they had margin requirements, they were typically 50%, so regulation T margin, but they would do things like basically allowing customers to trade immediately. So if you open a new account, you deposit money, Robinhood doesn't get the money yet, but Robinhood lets you buy immediately. Mm-hmm. And so in those cases, they are temporarily giving you 100% funding, basically zero margin. And so this is another thing that could lead to a cash crunch for them. But also you could have a guy who has IBM stock in his account. He sells IBM. He takes that and money that is credited to his account and then use that to buy GameStop. But Robinhood doesn't get the money from IBM yet. Mm-hmm. They'll only get the money from IBM 2 days from now.
Key issue. If you had instant settlement and payments, it would not be an issue. Is this the conclusion, or?
Well, you need still some margin to make sure that the whole thing is smooth and instant. I don't know if it's ever going to be completely instant, but it's true that the risk that the clearinghouse takes is sort of proportional to the time of settlement. So the longer is the settlement period, the more risk the clearinghouse is facing, and therefore the larger is the margin requirement that they need to impose.
So Laura would like to know, just to put this billions in perspective, how big is Robinhood's asset under management? Do you have an idea? Is it the same ballpark, or how many billions are the assets under management?
I don't know that number. I don't think they would call it asset under management as a broker, but that's besides the point. But so remember, there is all the client money is one thing, and then there's Robinhood's own money, their own account, their own the value of the owners of Robinhood, and the 3.4 billion goes into the owners, the firm Robinhood, which is separate from the client accounts. So the two are not really apples to apples discussions. Mm-hmm. Okay. Now, I know you also wanted me to talk about payment for order flow. Now, I think, to be totally honest, that, it's a bit of a red herring. I don't think payment for order flow has much to do with GameStop and the way the stock price moves, but I do think it's a very interesting issue. But it's one that has been discussed a lot in the hearing. So I think let's talk about it. So payment for order flow is this idea that Robinhood, let me go back here. So Robinhood pays money to Citadel and other market makers to have them execute the orders. Okay. So why is that going? It sounds kind of fishy, and I can see why people would worry about that.
You often explain this a connection between Citadel and Melvin.
Yeah. So Citadel is wearing basically several hats here. So Citadel Securities is a broker that helps other brokers like Robinhood execute their trades as a middleman. Citadel also, separately from that, runs a hedge fund that itself trades in the stock market. And Citadel also made an investment into Melvin's hedge fund as one of their investments. So Citadel are doing these three things. And that's one of the things they're being criticized for, although it's not clear that there was anything wrong with any of the things they're doing. But one of the things that they've been getting most press for was, the fact that they and other market makers are paying guys like Robinhood to execute their trades. And that is what's called payment for order flow. Does that make sense? So why do we have payment for order flow? So again, Citadel and other market makers, they would love to earn what's called a bid-ask spread. So if we imagine a limit order book here on the right, suppose right now there's a bid at 3 and there's an ask at 301. So what a market maker would like to do is all day buy for 3, sell for 301. Buy for 3, sell for 301, provide liquidity, earn a small spread for providing that service of providing liquidity. Now, if the price stays at 301, they're gonna make money. Now, they could lose money if, suppose, somebody is selling to Citadel. So Citadel buys at 301, and then people keep selling. Eventually, Citadel will have a bigger inventory, and at some point they'll stop taking inventory. They'll pass these orders on to the market. The orders will hit the market. They will move the market up. Now, Citadel has a long position. The price is moving up. They're losing money. Okay, so in the academic theories, this is basically called that there could be informed investors, informed counterparties, who know something, let's say, about the fundamental of the stock. And so if there's an informed buyer, he will push up the price, and the market maker will lose as a result. In real life, these things are in such a short time scale that I think probably a more important effect in real life is that a market maker doesn't like to have a large counterparty. So if an institutional investor is buying 100 shares, but those 100 shares is the beginning of buying 1 million shares, they just keep buying all day and all day next day, this is going to be a source of loss for the market maker to provide liquidity to those first 100 shares. So what market makers love is retail investors, because they're very attractive counterparty. Typically, they're not informed and they're not large. So their orders are mean reverting, and it allows the market maker to just, again, buy at 3, sell at 3 or 1, and just earn that bid-ask spread. So they are willing to pay for that, for the right to provide that service. So if Robinhood just sent the orders to the market, any market makers could provide liquidity. If they send them to Citadel, Citadel will get 100% of the market making revenue from those trades. Now, to see why that's especially important, sometimes the minimum tick size of 1 cent is binding. When that happens, it means that truly the equilibrium bid-ask spread is less than 1 cent, but by regulation it's set to 1 cent. So when that happens, there's a queue on 3 and 301. There will be many limit orders saying, I would love to provide liquidity and buy at 3, for instance. Now, if an order is sent to Citadel, they get to skip the queue. Normally there's time priority, but if you send them to Citadel, it doesn't matter who's first, they get the order first, they can just take it and provide liquidity. And so they make that tiny bid-ask spread, and so they're willing to pay for that. And so that's what payment for order flow is. How does that affect retail investors? Well, first of all, the payment for order flow goes to Robinhood, but allows Robinhood to have 0 commission. So in some sense, that money is refunded indirectly to the retail investor through extra normal low commissions. Also, sometimes they will get price improvements because, rather than saying, okay, I sell it to you at 3 or 1, they say, let's sell it at a sub penny, 3,008, let's say. So they give a sub penny improvement. The exchange cannot do it, but Citadel and other market makers can do it off the exchange. Okay, so this is good for the retail. You can say, is there something bad? Well, one of the losers in this is actually institutional investors, because when you take this noise trader order flow out of the game, the institutional investors who are left on the exchange will have to face larger market impact costs. So, that's bad for the institutions, still good for the retail. Could there be some conflict of interest? Maybe if the market maker trades ahead of the retail order, but this is not allowed. Could there be better transparency? Yes, definitely there should be transparency about this. And I think there could be improvement where, how good of an execution a market maker gives the broker should be more transparent. But, Ken Griffin said under oath that, and I think he's right, that basically retail investors have never had such a low execution cost ever in the history. And I think that's true. I mean, we're talking about tiny numbers here in terms of the all-in cost for the retail investors. So the retail investors are probably facing the lowest trading cost of anybody in the system right now.
But would you argue that we should actually reduce the tick size to below a penny?
Yeah, why not? Why not? Let the exchange set it at whatever they want.
Okay, so you would switch off this, and then probably a 0 commission would go away as well for the retail investors.
We don't know. It's still attractive to potentially, I don't know, we'll see. But, competition has been a good force so far, and reducing tick size has been part of if you're a market maker, you love a huge tick size, right? Because it means that you're guaranteed a big price for that service. Now,
but if others can jump the queue and I'm a market maker and other market makers are allowed to jump the queue, that's not good for me. No?
Well, if you're retail investors, it is good for you that the market is segregated into the retail and the more toxic and institutional flow. So with the fact that you're allowed to separate out allows the retail guys to get very low transactions cost. So it is actually paradoxically in this case a good thing. Probably. I mean, I think more research can be done, but I think if we want to come back to GameStop, nobody bought GameStop because of this. Nobody, I mean, this is not the story of GameStop. This is a different story in my opinion.
Can you just highlight, if you put this market makers in and algo trading, how would algo trading fit into this picture, or does this go too far away from?
Well, some of these market makers are using algos, they say, to basically say, you know, this is when we take it on our own book. Now we have too much inventory. We pass on these orders to the exchange and so on. But algo trading is many, many things. Okay, so this was sort of on the buy side. What about the short sellers? What were they doing? You know, sometimes a short squeeze can happen for technical reasons. So Markus mentioned this, absolutely right, that sometimes basically the shares are recalled. The short sellers are literally forced to close their position. And if they're forced to close, you know, the price can go to almost any level in theory. In the case of GameStop, my belief is that this is not what happened. The securities lending market was affected by this very high turnover to some extent, but it largely remained open. So short sellers, they could have continued to short. It's not like a hedge fund could not short. Hedge funds could continue to short, but they simply could not sustain the losses they were facing as the price kept going up. So basically what happens is that if you buy a stock at 100 and the price drops, the size of your position goes down, and typically the volatility, at least in dollar terms, will go down. So if the volatility is 10% at 100, you know, stock price, let's say, moves from 90 to 110, then it drops to 10. The volatility is now much smaller. Stock price may go from 9 to 11. So in dollar terms, only $2 moves. When it's short, it goes from 100 to 1,000. Then even if the price volatility stays at 10%, right, all of a sudden price moves are from 900 to 1,100. So much bigger price moves. So the size of your position in dollars and also the volatility goes way up. Plus you're losing money at the same time. So short sellers were facing big losses, big increases in the size of their position, big increases in the volatility of those positions. Also, again, we mentioned before, volatility going to 300%. So they started reducing their positions. Now, short positions, we know with certainty or some certainty every 2 weeks, but there are ways to try to estimate it. Here I'm using some data from market and other data and to try to estimate it. You've heard the number 140% when you do it as a fraction of float. When you do it as a fraction of shares outstanding, we are closer to 100% in the beginning. But then we can see here's the solid dark line here, this estimated shorting level, which again is estimated with some error, starts, let's say, around 100 and then goes down to, you know, just over 20 or 20 or 30 or whatever the number is, but it goes way down, and it goes way down over this critical week. So here I have on the same graph the closing price. So we see here's the week where the price goes up, and this is the same time as the short positions are going down. So remember, I mentioned earlier that part of the price increase was actually the short sellers being forced to close their positions, or not forced, but because of risk management issues, they felt compelled to reduce their positions, and that actually contributed to the problems, much like in our paper.
So Lasse, I have two questions. One is like HP would like to know whether, you know, if this are real shortings, or what's about synthetic shorting with derivatives? Can you elaborate on that? I think you touched upon that, but just the synthetic shorting versus.
This is real shorting, I believe, yes.
And synthetic shorting you would do with derivatives, it would be subject to the same margin calls and aspects like that. So.
Yeah.
So the other question is from Paul Erickson. He asked this long time before. If the GameStop stock price was $18 before the whole episode, and after the short sellers went out, the stock price is now $39 or whatever it is this a clear signal that the shorting guys depressed the price from 39 to 18? Can you make such statements? Or
I don't think you can make such statements. I think one of the things that's really missed in this whole debate is that short sellers can have two effects. In some sense, they can reduce prices when they think a stock is overvalued. You know, they will short it, and that can push a downward force on the stock price. You know, and if the short sellers are right, that's good, because if your grandmother is buying a stock, who's going to ensure that she's not buying something worth $20 or $40 for 400? Well, the short sellers are part of making sure that that's happening, make sure that capital is allocated to a vaccine maker rather than GameStop, perhaps, because they keep the prices in check. So yes, short sellers can reduce prices, and hopefully they'll do that when that is the efficient price. But short sellers can also actually increase prices, and I think people don't understand this, because this is one of the puzzling things where the microeconomic effect and the macroeconomic effect are the opposite. So again, the microeconomic effect is that if a stock price is too high, short sellers can reduce it. Now, if they do that well and make the market more efficient, if they reduce volatility, if they make prices more right, you know, the more people may be willing to own equities because prices are less volatile, they're more stable, they're more stable. And if therefore the required return goes down on the whole stock market becomes more valuable, companies can better finance themselves, we can have more economic growth. So in principle, and you know, we can do more research on this, but in principle, the macroeconomic effect of shorting could in fact be to increase prices.
Can I ask, so John Muller would like to know, have you looked, or somebody looked at some borrowing cost or the lending fee or the borrow shares?
Yes, so that's in fact on my next slide here. So here, this is some data from S3. It goes from 2020 through this event, 2021. We have three lines: the bid, the offer, and the last. The last is very volatile, and it's, I think, probably some retail investors eventually paying as much as 200%. Now, 200%, by the way, sounds crazy, but remember, that's if you short it for a year. If you only short it for, let's say, 1 day, that's, you know, 1 percentage point or something like that. So it, you know, if the stock then falls 50% over that day, you know, that's just a small cost. Now, if you think about what a hedge fund would pay, it's more sort of in the range of this bid and offer. I think a realistic number over this period is that hedge funds were paying 30% annualized to short the stock, or other institutional investors. So 30%. Now that number actually collapses here at the end of the sample. Now, why do you think it collapses? Collapses because the price of anything is supply and demand. And here we know that the number of people who wanted to be short went from 100% to, let's say, 30%. So when there's much less shorting demand, the price of shorting goes way down. Okay, we also know that the fact that, you know, they had this large position when the price went up, and then when the price collapsed, they made money, but they made money on a much smaller base. Meant that they overall, as a group, estimated by S3 again, lost about 15 billion, and then they only made 6 billion back. So as a group, they lost billions, a lot of money. So when this one retail guy may have made 12 million, Mr. Gill, you know, that's a very small part of this whole event. So why did the price eventually fall? You know, these recent buyers on Reddit and so forth, they were talking about diamond hands of holding forever, but many of them certainly had no intention of keeping the stock at levels around 400. And the fact that, you know, they were just buying and selling, and you know, seemed like buying things they talked about having a much smaller fundamental value, seemed like a clear sign of a bubble or sign of predatory trading. Could be new short sellers, but again, we know that yes, some of the short sellers who closed were replaced by new ones, but much less so. So this is not the reason. So the short sellers were not pushing down the price, you know, from 400 to 60 or whatever. could have been the previous owners, right? If you believe the company was a good company at $5 or $20, then the company goes to 400, you're going to take profit eventually. So that's certainly a big part of it. So those are the guys who are perhaps some of the big winners, the old owners who sold at these astronomical prices. But prices tend to converge to fundamentals, and the long time the price drop was a matter of time, with or without short sellers. It was not the short sellers that made the price come down from 400. If anything, it was the short sellers covering the shorts who contributed to this very high level.
Do you know what the mutual funds, so think for example, would like the mutual funds sold it?
This I don't know. But I assume that some of them would take profit too. As we talked about, it's spread over to other market, AMC, Bed Bath & Beyond, BlackBerry, Silver had a little bit of a move, but AMC had a big move, and they actually issued into this move, but actually mostly just before the big price spike. But I also want to be mindful of the time, and want to spend just a little bit of time just talking about, if you have a few more minutes, talk about what do we learn more broadly here. So I think we learn a few new lessons, and we also, I think, reinforce a bunch of old lessons. We enforce the old lesson that demand does move prices, both for stocks and stocks. Markets are not perfectly liquid. We learn that demand can be rational, and even there's evidence that even repeat news will move the price. Old news moves the price again. We learn again that shorting can be difficult, can be risky. We learn that predatory trading can be a form of price destabilizing speculation. But what about the new lessons? I think, Markus, you hinted at this. Social media is a big new trend. This innovation in IT. I think there was this big hope that improved information sharing would lead everybody to be more informed. That will lead to more truth in politics and in many aspects of life, more efficient markets in the financial realm, and that will just lead to better political, economic outcomes for everybody. But of course, the fear is that, despite this improved information sharing, people get more confused that as you talked about, there can be these echo chamber effects, fake news that are circulating and so on, that will lead to worse decisions, worse outcomes. And, we'll see. I think the jury's still out. I think these, one incident here and there certainly is not data. So we need to study this more seriously. We have these predators who left a paper trail that people can look at in terms of reading Reddit. There's a lot of reading to be done there, or watching movies. There's this discussion of, is it the moral thing to fight against the short sellers? Some in finance textbooks, short sellers are often making the markets more efficient, but they're often the villains in the press. And, there's discussion of inequality. I don't think that, retail trading is the right way to fight inequality, if that is the goal. But that's part of the discussion here. You can talk about the size of the effect. You can make some quick calculations. GameStop obviously had this 20x astronomical price increase. It went from around 1 billion to around 34 billion. So that is, some real change, but it still only ended up being, 0.07% of US equity. So it's still a small corner of the market. Another, way to think about it is the Gap is another sort of retail firm, sells clothes, as you know. It's about 9 billion, so it got a lot bigger than that. Moderna, the vaccine maker, 71 billion, so sort of in that range. But it collapsed again. It didn't issue any money. It's just a zero-sum game. It went away after, some days. They couldn't issue for some technical reason related to some inside information the executives had. It spilled over to us a few other things. AMC was able to make an issue, survive, keep showing movies in the cinema. But again, it seemed like, just on its own, it wasn't like a huge thing. So if it's the entire iceberg, I don't think we should worry too much about it. If it's the tip of the iceberg, that's a different story. And which one is it? I think it's certainly not the entire iceberg. I have a paper just forthcoming on deep value where we show that these kinds of things are kind of happening all the time, with big price dislocations on the downside and on the upside. I've seen it. This is the price graph from our paper. This is a real minute by minute price graph from the coin prices that looks almost the same. So those kinds of effects were also a big part of the global financial crisis, where a lot of this was not predatory trading, but it's this very closely connected thing where liquidity problems and demand pressure reinforce each other in a liquidity crisis. So I think the conclusion is that every time we write a paper, there's a crisis that happens as a result, and I'm starting to think that you are making it happen just to prove your paper right.
I know, right, with you. So let me just conclude with some questions which are out there. So one is from Peter Coy, going back to the settlement. Do you think, do you have any take on, he would like to real-time settlement versus real-time gross settlement? Is this a big distinction, whether, just settling immediately the net positions or settling the gross positions? Do you have a take on that? That's a very specific question.
I think it's a very specific question. I think, I don't hear anybody being against more efficient and quicker settlement. I only hear everybody saying it's a good idea, but it's just, somebody has to make it happen. So I think, economics is often interesting when there's a trade-off on one hand, on the other hand. But I think we can all agree the world should be better and smoother. And
I mean, one could make the case that, if you make everything faster, to manage a crisis is also faster than you have less time to bring the whole problem to a weekend and then you sort things out. If everything moves much faster, then it gets out of spin and out of control much faster as well. But of course, everything has to be slow. If settlement is slower, trading should be slow. You can't make trading very fast and settlement very slow, I guess.
Yeah, I think what you're referring to also is what, sometimes you had trading halts in the past. I think it's a separate issue from the issue of whether settlement should be at a delay versus the actual trading.
Do you see any new technologies like tokens and, not blockchains, but, in this space, which makes settlement easier? Because there was a comment early on in the chat box saying, oh, it's actually not so easy to find a stock to borrow, but if everything is tokenized, is it a technology issue? I'm not sure whether you're the expert on that.
Yeah, I'm certainly not the expert on that. I would say that I don't think I think it's possible that blockchain and so forth can be part of the solution, but it's all electronic anyway. I think sometimes people talk as if the alternative to blockchain is having some share certificate which is physical and we have to run around with it. I think as long as it's electronic, I'm sure there should be many possible solutions, but I'm sure it's easier in theory than it is in practice.
So let me throw another bunch of questions at you just to conclude. So there are many questions which are about the regulatory environment. And I guess I throw all at you right away. So Laura in particular would like to know, if we had a strict uptick rule, would this have made any difference? We had always for shorting this uptick rule. And what's about, so Elena would like to know, what's about a financial transaction tax a la Tobin tax? Would this have made a difference, so that actually trading is not so cheap? You always have to pay some transaction tax. And finally, the third regulation, which is related to margin spirals we worked on, that you don't allow essentially the brokers and the clearinghouses to adjust the margins so quickly as volatility changes. So you have some procyclicality in the margins, you switch off the procyclicality. So these are three regulatory, and I know it's quite a handful, but yeah, perhaps you can say something to that.
I think the uptick rule, I think it creates a lot of difficulty also when you have many markets trading at the same time. It's not completely clear what is an uptick at the same time. And at the same time, with when the market is going from you know, with these tiny Bidask spread, it's typically, to the extent that you can make it work, you can also find an uptick. So I don't think it's really a binding constraint. It becomes more of a hassle than a real binding constraint. So I haven't seen any serious research to confirm this, but my guess is that it would not have made a difference in this case, or nor would it typically. In terms of the Tobin tax, again, when things are moving from, you know, $100 per share to $400 per share in one day, I don't think people would worry about a tiny Tobin tax. It's on a completely different scale. I think most serious proponents of the Tobin tax think that it's probably a distortionary tax like any other tax, but it's just less bad, perhaps. I think that would be the strongest argument, that if there are some positive things, there will also certainly be negative things of a Tobin tax. But, you know, is it less bad than an income tax? I don't know. I think that's more where serious people could disagree. In terms of the margin requirements, the trade-off there is that, you know, if you make margin requirements more predictable, more slow moving, as you mentioned, that will make it easier to meet them. It'll be better for the people who have to post margin. But of course, to the extent that they get out of sync with reality, it also means that people could have too little margin cash in their account, and would expose the clearinghouse to credit risk of the counterparties. And so that could be an issue for systemic risk. So okay, let me just end with saying on one hand, and on the other hand, so I can be a real economist.
So Morten would like to know, I think we touched upon that, would you limit the amount of short selling to as a percentage of the float of a stock? And then we have the tradition in this webinar series that we always end up with an uptick, with a positive note. Perhaps, is there anything positive coming out of this episode? We have learned new things, and can you see a positive outcome at the end?
Yes.
And perhaps there's one more question. Basanta would like to know, how can markets be efficiently inefficient? And you're the expert on that.
So markets being efficiently inefficient, as you know, is the title of my book. So by that I mean that markets are inefficient because somebody has to make them efficient. They don't become efficient on their own, and there are all these crazy things happening. So they are to some extent inefficient. But there are also tons of smart traders who are trying to exploit this and push prices in the right direction. And so they have an efficient degree of inefficiency, is my point. Now, what was your first question, Markus, before I had to end on a high note?
Oh, no, I forgot it too.
From Morten, you said.
Sorry, I forgot.
That's okay. But should we end on a high note and say?
Also, the amount of shorting, should it be a percentage of the free float?
Oh yeah, I think most short sellers would be wise to study the amount of shorting and make sure that they're not having a large position in a heavily shorted illiquid stock. You know, that's in people's self-interest. Do we need to regulate it? I'm not sure. I think it's certainly people that will have a self-interest to monitor this, and maybe, you know, there could be some warnings when it's too high or reaches a certain level. I think some warnings certainly would make a lot of sense. Whether we need a hard stop, I'm not sure. And
the positive ending?
So the positive ending is once again you created attention of your paper, and so that's positive. But also I do think we learned a lot from this very interesting episode. I think, you know, my kids are suddenly becoming very interested in not just buying games online rather than GameStop, but actually talking about stock prices and talking about, you know, what is the efficient value of stocks and what is the role of social media, and you know, what's going on Reddit and other sites, and what is the truth, what is, you know, how do you even judge the truth from what you learn on these social media. I'm an optimist. I do think that technology will typically, help us move us forward, make the world a better place. But it doesn't do so in a linear way. It does it in a non-linear way that bumps along the way. But let's hope for a bright future.
Great. Thanks a lot, Lasse. It was a pleasure to talk with you over the week, actually, and catch up on all these things. That's perhaps another positive side effect of that we could talk about our old paper again and talk about all these things. And let's hope that the markets will become more efficient, or as you say, more efficiently inefficient, at least as long as efficiency is sufficiently close to full efficiency. I think we should all be fine. Thanks again. Talk to you soon.
And thank you. Thanks a lot, Markus. Great job.
For being with us and learning with us. Bye-bye.